Welcome to The Explainer. Today, we're going to decode the numbers that tell a company's real financial story. We're talking about profitability ratios. These are the tools that show you not just how much money a business is making, but how well it's making it.
So to get us started, let's play a little game. I've got two businesses here. Just take a quick look. Which one do you think is doing better? Now, at first glance, you're probably looking at company A with its 10 crore in sales and thinking, well, that's a no-brainer. But here's the thing. Sales figures are just the headline. To really get the story, we've got to see what's left after all the costs are paid. And that, my friends, is exactly where profitability ratios come in.
Okay, so our very first step is to figure out how much profit a company makes just from its core product, before we even think about other business expenses. This brings us to a really fundamental ratio, gross profit.
To get the gross profit ratio, it's pretty simple. You just divide the gross profit by the net sales. And this little number is a huge deal. It tells you exactly how efficiently a company is making its products and managing its direct costs, things like raw materials and factory labor. So a higher number here, that's a really good sign that they're being smart with their spending.
Let's look at this with some real numbers. Okay, so we have sales of 50 lakh. The cost of the goods they sold was 35 lakh. That leaves a gross profit of 15 lakh. So what's our ratio? It's 30%. In plain English, that means for every single rupee this company sells, it gets to keep 30 paise after paying for the direct costs of actually making the product.
Making the product is just one part of the puzzle. You also have to, run the whole business. Next, we have to factor in all those other operational costs. We're talking salaries, marketing, rent, the whole shebang. And that leads us to operating profit. This is where it starts to get really interesting. See, the operating profit ratio looks past all the day-to-day noise. It focuses right in on how profitable the company's main business is, giving us a super clear picture of whether their fundamental business model is working. And this is all before we even get to things like interest and taxes. So using that same company, we can see their operating profit is 10 lakh. Now, when we divide that by the 50 lakh in sales, our ratio drops. It goes from 30% all the way down to 20%. So where did that 10% go? Well, it was eaten up by the costs of just keeping the lights on and running the business.
All right, let's get to the one everyone knows, the bottom line. This is the final measure that shows us what the company actually gets to keep in its pocket after every single expense, and I mean everything, including interest and taxes, has been paid.
And here it is, the net profit ratio. This is the ultimate test of a company's overall profitability. It answers the one question everyone wants to know. After everything is said and done, for every rupee of sales, how much pure profit is left? So, after all of that, our company's profit after tax is 6 lakh. That gives us a net profit ratio of just 12%. Think about that for a second. For every single rupee that came through the door, only 12 pesos are left as actual take-home profit.
Okay, so we've peeled back all the layers of profit. But there's another side to this story, and it's just as important. It's not just about what you make. It's about what you use to make it. Let's talk about efficiency.
That's absolutely right. A company could have amazing profit margins on paper, but if it takes a mountain of assets and resources to get there, well, it might not be such a great business after all. Our next couple of ratios are going to help us figure that out.
First up, we have return on assets, or ROA. This one asks a really simple, powerful question. For every rupee's worth of stuff the company owns, we're talking its factories, its cash, its equipment, absolutely everything, how much profit does it manage to squeeze out?
And it's a perfect illustration. With a net profit of 6 lakh and total assets worth 40 lakh, this company's ROA is 15%. So what does that tell us? It means for every single rupee of assets on its books, it's generating 15 paise of profit.
Now, let's zoom in a little bit with something called return on capital employed, or ROCE. Unlike ROA, which looks at everything, this one focuses only on the money that has been actively invested in the business by shareholders and lenders, the capital that's expected to generate a return.
For this one, we use a number called earnings before interest and tax. With that at 9 lakh and the capital employed at 45 lakh, we get an ROCE of 20%. This tells us that the company is generating a 20% return on the actual money that's been put to work to grow the business.
So, to make sure we've got the difference straight, think of ROA as the big picture. It looks at how every single asset is being used to make a profit. ROCE is more focused. It gives you a sharper view on how well the company is using the specific money that investors and lenders have given it.
And look, at the end of the day, these numbers aren't just for accountants. They are literally the language of business. They have a huge impact on market valuation, on investor confidence. For people running the company, they're essential for making smart decisions. And for investors, well, they're absolutely crucial for judging a company's health and its future.
So that's our deep dive into profitability ratios. They paint this incredibly detailed picture of how a company has performed in the past. But the real magic, the real power, is using that picture to understand what's happening right now, and maybe, just maybe, get a peek at what's coming next. The big question is, what story will these numbers tell tomorrow?